India today delivered a second consecutive 25 basis point rate cut in 2 months on the back of growth and inflation pressures. But the Reserve Bank surprised the market by maintaining a neutral rather than a dovish tone. The Monetary Policy Committee voted 4-2 in favour of a rate cut of 25 basis, taking the repo rate now to its lowest level in a year to 6%. The RBI also cut the inflation forecast by 40 basis points to 2.9 to 3% for the first half of the current year and to 3.5 to 3.8 for the second half of the current financial year. But despite lowering inflation projections rather steeply, by 40 basis points, the MPC voted 5-1 to keep its stance, the stance of the monetary policy, unchanged in neutral mode, leaving the markets perhaps wondering if there are any or many more rate cuts to follow. On the growth front, the Reserve Bank has also cut its projection for FY20 by 20 basis points to 7.2 from the earlier 7.4%. Listen to the big man himself.
The inflation outlook remaining benign, the RBI will address the challenges to sustain growth of Indian economy while ensuring price stability on an enduring basis in pursuance of its mandate in the Reserve Bank of India Act.
Okay, so given benign inflation, we will pursue growth. Then why not a little more by way of dovishness? Okay, we'll come to that. Besides the policy actions, the Reserve Bank allowed banks to count an additional 2% of their SLR bonds, statutory liquidity ratio bonds, towards their overall liquidity coverage ratio. The long and the short of it means that banks have to keep a little lesser part of their deposits in government bonds and therefore can lend 2 percentage points more of their deposits to borrowers. The Reserve Bank has also said that its drive to force banks to link their retail and SME loans to external benchmarks is being deferred for now. The governor also indicated that the central bank will come out with a revised circular on bad loan resolution. This is needed after the Supreme Court recently scrapped a similar circular which controls NPAs, which was issued on February 12th, 2018.
The Honorable Supreme Court has said that the powers of RBI under Section 35AA have to be exercised in a particular manner, and the validity of the Section 35AA stands, and henceforth we have to comply with the directions of the Supreme Court in this regard and act accordingly. In the light of Honorable Supreme Court order, the Reserve Bank of India will take necessary steps, including issuance of a revised circular as may be necessary for expeditious and effective resolution of stressed assets. The RBI stands committed to maintain and enhance the momentum of resolution of stressed assets and adherence to credit discipline.
Okay. Well, that was the policy, the key policy part and the other important announcements for bankers. All markets, stocks, bonds and rupee fell after the policy announcements. Now, what are their worries? Welcome to the Monetary Policy Special. I'm Lata Venkatesh, and with me is a high-powered panel of bankers and economists who are going to help us understand the immediate and the medium-term ramifications of this policy. With me are Dinesh Kumar Khara, Managing Director and of the GBS Global Business and Global Business Wing of SBI, Rajiv Anand, Executive Director, Wholesale Banking of Axis Bank, B. Prasanna, Head of Global Markets at ICICI Bank, and Pranjal Bhandari, Chief India Economist at HSBC. Gentlemen and lady, thank you very much indeed for joining us. First to the lady, of course. What's the takeaway, Pranjal? How many more rate cuts, if any?
Well, I think today Governor Das, treaded the fine balance quite masterfully. There were definitely two parts to this policy. The first part was the 25 bips rate cut, which is consistent with the cut in the inflation and growth forecasts. And the second part is the fact that it stuck to its neutral stance, didn't change it to accommodative, as many people had thought, he would. And I think the big reason for that is that they see a lot of upside risks in the horizon for the future. Two of them are El Nino. A possibility of an El Nino by their own assessment could add 50 basis points to inflation. And the second is fiscal. There has been a lot of fiscal excesses in the economy for the last couple of years. Especially this year, we're seeing central governments, state governments, and public sector deficits and borrowings remaining quite high and being quite excessive. So when your fiscal is so high, then it's the monetary cannot be so high also. So keeping all of that in mind, they kept the stance at neutral, and I think that was a very nice balancing act. With all of this behind us, we think at the most there is space for 125 basis points rate cut. Perhaps in the June meeting, if not June, then in the August meeting. But that's about it. We don't see space for any more beyond that.
Okay, I will come back and revisit this point with you, Pranjal. I'm looking back. The last time the inflation rate was above 4% was in July of 2018. From August 2018, it is below 4%. And the repo rate at that time was 6.5%. So we are running with a 225 to 250 basis real rate. For the past 6-8 months, it has only increased with increased to 300 basis points with inflation falling to 2%, 2.1%. And now for the next 12 months, we are going to have, or at least the next 6 months, we are going to have inflation at 3% and repo rate at 300 basis points real repo. No space to say accommodative. I'm not yet convinced, but I'll come to that in a minute. First, let's get to the here and the now in terms of what difference the policy makes to borrowers and depositors. Mr. Khara, do not tell me that my rate is linked to the repo rate for the savings, for the 1 lakh plus savings, and therefore that will fall automatically. We know that. I'm asking you beyond that. Are you likely to cut any of your fixed term deposit rates or your lending rates? Or do you see the system itself passing on this in any fashion?
Well, of course, we'll have to take that kind of a decision on the basis of the data which we'll collect, and we will deliberate in our ALCO. But what you mentioned in terms of the likely impact on the deposit rates, that is also a function of how the other instruments are offering the interest rates. So that is, it's not merely the repo rate. It will also be, of course, we have sort of tried to link up our deposit rates to the repo rate to some extent for the deposits above 1 lakh rupees in the savings bank and otherwise also. And likewise, when it comes to transmission, essentially from the point of view of the transmission for the loans, that we have linked up with the repo rate. So that will, in any case, will have an impact because repo, the benchmark itself has changed. So that will have an impact on the loan rates. So that is what we are envisaging.
Okay. So if I have a home loan with SBI, I'm not getting lower EMIs now.
Well, as far as we are making it effective from 1st of May, this repo rate link interest rates, which would be effective from 1st of May. Okay. So at that point of time, you will perhaps have the benefit of the lower EMI also. Okay,
I've seen a lot of advertisements, so I'm sure I'm going to have a lot of customers. Okay, now let me come to the nub. Prasanna, what is in this? What is in it for yields? The yield actually rose by 10 basis points after the rate cut. So interpret the yield market for us. How do you see it going from here on?
So, Lata, I think I will agree with Pranjal on this. There's nothing much to complain about this policy because most of the analysts actually went into the policy with the expectations of a 25 basis point cut with a neutral stance. It was just that the market went a little ahead of it in the last week or so, and there was a hope that because of the dramatic slowdown in the global growth, as well as the growth momentum slowing down in India, as well as inflation being contained, a whole lot of reasons you can give, the market probably hoped that the governor will go, or the MPC will do a little bit more than a simple 25 basis point cut. And that was either in the form of a higher, deeper cut of 50 basis points, or it could have been in terms of changing the stance from neutral to accommodative, or even it could have been in terms of a liquidity stance being aligned to the rate stance. So this was the combination which the market was expecting at some level. And when the governor and when the MPC actually delivered exactly as per script, which is what possibly you can argue that the economy needs at this stage. The market had to unwind some of the excesses of the last 7 days or 10 days. So I think that in a nutshell exactly explains why there was an uptick in bond yields post the policy. It is not a statement on the policy itself. It is just that the market went into the policy with much bigger expectations than what ultimately came out.
Okay. So, Rajiv, therefore, do you think anything changes for the borrower? If the bond markets, actually the yields have gone up, then for a borrower, nothing has changed.
I think, a couple of things have changed. One is, the very tight liquidity conditions that we saw pre-31st March. I mean, clearly we've seen that liquidity conditions in the marketplace have, certainly improved thanks to government spending and so on and so forth. Over the last few days, we've seen a fairly sharp rally at the short end of the yield curve, although it sold off a little bit, today. Post the policy, but as Prasanna was saying, it's a buy the rumor, sell the fact kind of reaction today. So I do believe that as the pressure from currency in circulation begins to ease off post the elections, I think there is some merit in terms of deposit rates coming off, and then MCLRs as a result of that coming off. But I mean, please don't look at this on a one-to-one basis. But I think certainly
will
the
you all cut? Will Axis cut?
Will
the banking system cut?
MCLR is down, but it will take a little bit of time.
You see rates falling shortly?
I think the point I'm trying to make is that I think the first deposit rates need to come off. We're still seeing fair amount of pressure on deposit growth relative to credit growth, and I think until we get some sort of an equilibrium around that, I think it's difficult for us to cut MCLR. I mean, remember that MCLR at the end of the day is a function of the marginal cost of money.
Exactly.
And so therefore, until the marginal cost of money begins to come off, to expect rates to come off on the other side is difficult.
Well, let me squabble on this a little more. Prasanna.
And, just one point here.
Sure.
I think we tend to focus on the lender. I think we got to spend some time on the depositor as well.
Fair point. I mean, I'm with you on that completely.
And I think ultimately, whether it's the RBI or the banks, we've got to take care of the depositor as well.
No, actually, you put your finger on it, because incrementally, credit is growing faster than deposits. If you looked at the Reserve Bank's weekly reportage for the last 8 or 12 weeks, on several occasions, the total aggregate amount of credit in the system has increased more than the aggregate amount of deposits. I'm not even looking at the percentage. So clearly, the depositor needs to be pampered with higher interest rates, which means zilch transmission, isn't it, Prasanna? That's what I'm coming to. Since the RBI is not able to transmit because at a balance sheet level, the system does not have enough deposits, should it have, or should it even in the future, go ahead and provide more liquidity? If instead of you borrowing from the RBI, if you were lending to the RBI, even like 10, 20,000 crores, if it ensured that kind of surplus, will there be better transmission? Should or will the RBI go that way?
So I think you're right, Lata. In fact, that is what I alluded to in my opening statement when I said that the market was hoping for a liquidity stance getting aligned with the rate stance. So the feeling or the hope was that because of the aggregate deposit growth in the banking system, not really capable of handling the kind of credit growth that's been pushed by the banking system in aggregate, which is to some extent a replacement of the NBFC growth and the mutual fund supporting the NBFC over the last couple of years. So that is the kind of gap between the credit and the deposit mobilization which is happening. And the other way to look at it is there has been a tremendous amount of currency in circulation which has been lost from the financial services as a whole, and that you can actually allude to maybe a whole lot of reasons, and also the fact that there is a savings investment gap at the end of the day. We are having a current account deficit. So you can answer it from a philosophical perspective also, that we need to set right the current account deficit. But coming down to the liquidity stance again, I I do agree with you that the behavior of a bank will be quite different when even at the same interest rate. The behavior of the bank will be very, very different when he is giving money to RBI versus he is taking money from RBI. So this particular point has been discussed ad nauseum earlier. And I think at somewhere the monetary policy did have a view that the liquidity stance has to be always kept tight, irrespective of whether the rate stance, whether the rates are going down or up. But I think the market majority, most of the market participants, as well as we at ICICI Bank, do believe that I think the phenomenon of transmission should be linked to what part of the rate cycle you are. And if the rates are going up, you need to keep the liquidity tight, and if the rates are going down, you need to keep the liquidity in surplus mode. So I think that is why there was some expectations of or the hope that RBI would come out with a far more bolder liquidity stance than what they actually came out with. In fact, they just said that they'll provide adequate liquidity for the system, which is basically a continuation of what they had said earlier. But they have their own reasons for that. They've taken a call, maybe that they need to deliberate it a little bit more time. But I think having said that, what you said is also right, that I do feel that transmission will be much better if liquidity is in surplus mode in general.
Well, if I had got a chance to ask another question, I would have tried to squeeze in and ask, is there a relook at liquidity at all? I did try to squeeze in that question, but the governor stuck to, answering that they will look at all options. But that's the question I really want to ask. With inflation being at historic lows, at least compared to the last decade, and growth requiring help, why did the Reserve Bank not go for a bolder accommodative stance? The Reserve Bank has announced monetary policy which cut repo rate by 25 basis but did not change its stance. We have been discussing with Dinesh Kumar Khara of SBI, Rajiv Anand of Axis Bank, B. Prasanna of ICICI and Pranjul Bhandari of HSBC, the nuances of this policy. Well, my trouble is that, Pranjul, starting from last August, when inflation fell below 4% at the headline level, the repo rate at that time was 6.5%. Starting from there, the real repo, ex post, the positive real rate has been almost 300 basis points almost throughout, and sometimes even going towards 400. Has the time come for the Reserve Bank and the MPC to shed some of its caution? Is it overcautious and, ensure that through liquidity and rate cuts, it ensures better transmission? Is this caution warranted?
Well, look, I take your point that inflation has been low for far too long, below target. And that's exactly the reason why we have another rate cut in our forecast for June, or if not June, then in August. But anything more than that will be risky at this point. And there are two good reasons for that. If you look at headline growth, headline inflation right now, both the numbers are very low. But our forecasts at this point seem to suggest that they'll go back up. Growth is below 7%, but after elections, we always see that, private sector spending comes back up as political uncertainty fades and growth picks back up pretty quickly. So I think that could change. Growth could easily go back to the 7% plus range. In terms of inflation, it's right now very low, under 4, but by March 2020, we expect it to go back up to 4%. Not much higher than 4, but at the 4% target. So that doesn't leave too much space for a lot of easing. The second is, look at things right now. Headline growth, headline inflation look very low, but that's just headline. If you look at the underlying momentum, things are not that bad. Core GVA actually rose in the December quarter sequentially and also on a year-on-year basis. Also, core CPI at this point is elevated at a plus 6%. So the underlying pressures from growth and inflation are not as soft as the headline numbers suggest. So for all of these reasons, I think some caution is warranted.
Okay. Well, I accept some caution. Maybe it is overcautious. Looking back at the way inflation trajectory has come about. Mr. Khara, I wanted to try and squeeze in just one question on the February 12th circular as well. It's going to be replaced. What would you like in it? Surely they will drop the reference to compulsorily taking accounts to IBC because that's the court's verdict. But will you want anything else rejigged, one-day default or anything else?
No, I think the February 12th circular, of course, we are expecting some kind of a redrafting of the circular. That is something which we are expecting. But when it comes to ability of the bank to go to NCLT or expedite the resolution process, I think about a year plus has gone, and banks had started looking at this as an opportunity for resolution of its impaired assets. So I think February 12th circular, of course, will enable the banks to really take that decision. Actually, what really happens is that many of the banks, since in the consortium, there is a play of many banks. So some kind of a overarching guidance from RBI helps in ensuring that there is a convergence of viewpoint for taking the account to a resolution process.
Saying that 66% should be written into the circular.
In the new circular which comes in.
Should that 66% vote is enough?
Yeah, I think something like that, which we have actually put in the intercreditor agreement, which actually permits us to do that. If that is incorporated into the circular, that will probably bring in enough discipline among the consortium members and also will steer them in the right direction also.
Okay. Rajiv, if you want to comment on that, how anything that you all would want tweaked, because the circular is anyway going to be written up again. But more importantly, now you have 2 percentage points more of your deposits which you can lend. What is your outlook on loan growth as well?
I think on the first question, you remember that the Supreme Court has already validated the whole structure of the IBC. All that has happened in the last Supreme Court judgment is that this whole issue of forcing companies to NCLT has in a sense been deemed ultra vires. But that does not stop banks voluntarily taking companies to NCLT, and I'm sure that the new RBI circular, as and when it comes up, will just sort of reinforce this in a manner that meets the legal requirements. Secondly, as far as
loan growth,
a better situation on LCR, our own estimate is that LCR in general over a period of time will improve by about 12%, which is quite significant. And ultimately, I think if you're not going to buy, if there is less requirement to buy SLR, by definition, that money should go into productive lending, and that's really what banks like us will do, who have the capital to be able to do so.
So loan growth in the system improves, you think?
Yes, I think so.
Okay. Well,
I think the constraint, what we've been talking about so far, the constraint to loan growth is deposit growth. And I think we've got to spend a little more time in terms of understanding why deposit growth is not happening. And I think one is household savings are not growing fast enough. Two, in that environment, there is various pulls and pressures in terms of where this money is going into, small savings and so on and so forth. And I think until we get deposit growth growing, I think it will be difficult and it will act as a binding constraint to credit growth as we go forward. And I think hopefully the world is going to look up much brighter on the other side of elections.
Okay.
And as private capex begins to kick in,
okay,
getting deposit growth going is an imperative.
Let me see if I can get the other bankers also to take a shy at this. But Prasanna, I wanted to wind up to say, how will you see yields move from here on? The LCR thing is actually bond negative because you guys are going to buy fewer bonds. And yet there is a very good, probability of inflation falling according to the Reserve Bank's own estimates. And probably, deft use of liquidity, dollar swaps as well as OMO. What is your best guess of where the yield can go by, say, May 31st, June 30th, even September 30th?
So I'm not going to give you a number for those dates, but I'll just give you a general direction in which possibly the markets will be moving. Right now, actually, as we spoke in the second half of the day, markets were busy unwinding all the expectations that they took into the policy. And as a result, the 10-year yields went up, the corporate bond yields went up, and so on and so forth. So as we go forward, I mean, yes, I do agree that inflation is going to be quite benign going forward. So there are expectations still, residual expectations that there could be one more rate cut somewhere maybe in the month of June or in the policy after June. But for that, I think a lot of uncertainties in the upside risk which RBI had mentioned should actually come through. Like, for example, oil price need to remain where it is. Then you need to have food price inflation not really going back as much as to disturb the expectations of headline inflation crossing 4% by end of the year. So for having said all this, I think the next rate cut is not ruled out. So I would basically say that there is, yes, definitely a possibility of a probability or a possibility of one more rate cut coming in. Okay. But what is also happening is that the government borrowing program is going to start and all earnest from Friday. And so the last 4 or 5 days was possibly the best part of this month when actually you had a forward-looking RBI policy with a rate cut. But then after that, you know, you have all the borrowing program kicking in. So again, the same story is going to play out. We are going to see a yield curve which is going to steepen. We are going to see the short end which is going to be well supported because of the fact that the funding rate has actually gone even lower. But on the other hand, the long end is possibly going to sell off a little to anticipate for preparing for the fresh supply which comes in from the government bond market. And on the corporate bond side, like you rightly said, since the hedging cost has come down because of the buy-sell swap announced by RBI first time around and now the second time around, I think the view on the spreads is a little bit more benign. I mean, at the end of the day, if GSEC yields are going to go up in the long end, it's very difficult for corporate bond long end to come, yields to come down. So I would again expect some kind of a steepening happening on the corporate bond curve as well.
Okay. So we are not going towards 7% for the 10-year.
No, I would put the new 10-year range to be in the region of 7.25 to 7.5.
Okay. Well, then there isn't much transmission through the bond markets or through the bank market. Well, actually, I guess the heart of the problem really is that for the lower middle class depositor, the competition from the post office savings rate and the other small savings rate is too compelling, and he doesn't bring the deposit to the bank. And for the slightly more evolved saver, the money market mutual funds are giving a better return than the deposits, and therefore deposit rates have to go up before they come down. It looks like transmission is not round the corner. Money is not getting cheap, despite the fact that we have got inflation straddling 2% for a goodish bit. This assessment of savings requires more time, but you all have enriched the discussion. Pranjul, Mr. Khara, Prasanna and Rajiv Anand, thank you very much for giving us the many facets of the monetary policy and the state of the economy. Thank you very much for joining.